following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
All right, and welcome back to Volatility Views, your weekly source for all things volatility related. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And of course, joining me today on the old Volatility Views panel is none other than Mr. Sell or Don't Sell himself. Good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the program, sir.
Thank you very much, Mark. And I got a present, a little surprise earlier when you told me that we were going to have a surprise guest on today, not one who was scheduled ahead of time. So I'm really excited and really looking forward to that.
Yes, if you can't tell by my tone of voice, listeners, I am very excited. We have a great guest coming on, Jared Woodard from Condor Options, to discuss, ironically, not iron condors today, but an article he just wrote about Nassim Taleb and the Black Swan and how perhaps his methodology is, let's say, a wee bit incorrect. I think the three of us are going to have a lot of fun on that topic, Don, because it dovetails so nicely into what we were saying on the last couple of episodes. And I will say this, listeners, stay tuned. There is a tidbit we released there in that segment that is known only to Jared because he had some conversations, some correspondence with Taleb that will, I think, change the way you think about the Black Swan in general, perhaps about Mr. Taleb himself, and certainly the way he presents his views in the marketplace versus what he actually does himself. I know I'm still reeling from it myself, so I'm very excited. I'm very excited to get into that. But before we do that, we have to dive right into our volatility review.
It's time for the Volatility Review.
All right, and welcome to the Volatility Review. This is, of course, the portion of the show where we dive into the week's worth of action from a volatility perspective. And because it's just Don and I today, we're going to focus on the land of technology, aka NASDAQ volatility. And that certainly actually has been where a lot of the action has been this week. There has been some movement, of course, in all the broad major indices this week, but it seems like every day tech has been leading the race, either to the upside or to the downside. And of course, when you're talking tech, you're talking NASDAQ. So that's been giving us a lot of grist for the mill for our vol review. So Don, what has caught your eye in the week's worth of NASDAQ volatility action?
Well, what's interesting, and because Mark is not here, I'll try to delve a little into S&P as well, is we didn't have a show last Friday, the day after Thanksgiving. I hope all of our listeners had a happy holiday. And so in preparing for the segment, I was actually going back 2 weeks in time, and I always like to take a look at our real vol indices, our historical 1 month, 3 month, even year indices, both in NASDAQ and S&P and many other assets, and take a look at again, what actually happened in terms of real market movement, measured volatility, and in this case, over the past 2 weeks. And believe it or not, the answer is almost nothing. And so when we were on 2 weeks ago, NASDAQ was at about 18 or so realized volatility for 21-day measurement. And in fact, it's at 17.5 right now. So actually lower. S&P, on the other hand, is within 1/100th of where it was 2 weeks ago. So virtually and completely unchanged.
Virtually unch, but of course you need a lot of vol to keep those levels that high. So there has been some movement, even though the net change is negligible.
So here's the thing that's really even stranger still, despite what you've just said. And of course, when you get low numbers like this, even a little bit of movement can actually create volatility of volatility, and therefore you can have a great kind of a range, even though the numbers are small. Percentage-wise, they're big. But something caught my eye, which is really a once in a, I don't know how many year type of event. I'm looking at the volatility of volatility, which is simply taking a look at volatility numbers and seeing how much they themselves move around. And I was struck by the low number of 47.8 for NASDAQ 1 month volatility. Now, we've talked about this before on the show. When you go on our site and you take a look at what we call VOV, or vol of vol, and you look at the historical charts, 1 month, 3 month, and 1 year are completely distinctive. They don't cross anywhere. They're three distinct lines where 1 year volatility averages, close to 100 on the indices, volatility of volatility. 3 month is more like a 30% or a 35% number, and 1 year is almost bond-like in single digits, like 7-8% volatility of volatility, which gets so smoothed out over the course of the year. So to see the 1 month historical volatility of volatility at 47.8% for NASDAQ is something that you see once in a blue moon. And so I tried to go to our historical charts and look, and I hope I didn't miss anything. I did it rather quickly before the show. We haven't seen a volatility of volatility on the NASDAQ this low since 1997. So 15 years ago, with a vol of 41, to have seen a number as low as this. So I think what that's telling us is not only are we in a fairly or reasonably low volatility environment, but that the actual fluctuations around these levels, certainly at least near term, have not been very impressive at all. We look at 3 month vol of vol, and they are at normal historical levels, 34 for NASDAQ, 46 for S&P, but we shouldn't be seeing similar numbers for the 1 month volatility, and we are. So just not a whole lot of anything going on at the moment.
So in the Don playbook, this is a don't sell environment.
I guess it's a don't sell environment, and unless you kind of consider the fact that something that Mark Sebastian has said over and over again, and he's right to say it, and he's correct, and that is we may have a whole paradigm shift here. We may have a completely different environment, and it's taking a long time for this generation of traders to have this sink in, namely that, for 100 years, if you look at the historical levels of volatility on, say, the S&P, for example, it is 15 or 16%. And, we've just had a period of time, Gulf War in 2000, dot-com blow up, 2007 and 2008, VIX in the high 20s, realized in the 20s on a natural basis. A whole generation of traders is looking at a 15 volatility 1 month on the S&P and saying, wow, look at how low that is. But, we just might have to come to the realization that this is what it is right now. And we may be coming back to much more long-term historical norms insofar as what we should expect in terms of index volatility.
We had a very similar discussion yesterday on our option block program, the whole concept of the frame of reference for volatility and how it has irrevocably changed over the past few years. And as we talked about on the show a number of times, people coming in and buying February 70 calls in the VIX and absurd things that a few years ago would have made no sense at all. Now at least to some people seem rational given what we've seen over the past few years. And it's all because of that frame of reference has changed. And who knows if we'll ever return to those good old days. I think a lot of people seem to be thinking we will be, given some of the paper flow we're seeing out in these vol products and the S&P, and just in general, the people who've been doing this for a while and have seen vol. Certainly, when I was standing in the SPX pit, vol of these levels, 15 was considerable. That was something to be noted. And it got into the 20s. You were like, wow, things are getting crazy. And now today, that makes headlines across the globe as vol is at record lows. So the frame of reference certainly has changed, and I think that's definitely something our listeners are cognizant of, and hopefully if they're not, they should be after having listened to this show for quite a while. And
and so that's the thing. So this is the type of environment that I was on a trading desk for years and years, in this kind of environment. And as we've mentioned before, I was happy selling time premium, and people look at this now and say, gee, how could you sell it at these levels? Because again, not to beat a dead horse, they're comparing it to what their frame of reference has been, perhaps for their entire trading careers, as to what is normal volatility. So, I don't know if I'd be selling them with both arms in this environment right now, but honestly, you're going to have to come around to a point where if you're afraid of this level because all you remember is, 25 and 30 or so, I think you're going to wait a long time to see that as normal again. I just don't think that it'll persist. Can we see a spike in volatility here to year end? And maybe we'll talk about it in a moment in the crystal ball segment. Yes, of course you could. But again, I just don't think that it's something that's likely to persist so that we all sit around and saying, oh, yeah, we're back to normal where volatility is 25. I just don't really foresee that.
And my mention of the Black Swan listeners was a subtle transition here into the volatility viewpoint segment. As you can tell, I'm excited. I know Don is as well, to get into that topic of the Black Swan and how it impacts the markets and whether it is indeed overpriced or underpriced, and along with perhaps a shocking revelation for many of you in the listening audience. So without further ado, we'll dive right into the volatility viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and that funky music means it's time once again for the Volatility Viewpoint segment. This is, of course, where Don and I welcome a guest on from the world of options and volatility and proceed to pick their brains mercilessly for 20 or 30 minutes. Today's guest / willing victim is Jared Woodard. He is the founder of Condor Options. Jared, welcome to the program.
Thanks. I'm really happy to be here.
Surprising we haven't had you on in the past. I'm surprised this show's been running for a while. I've known you for a while. Mark's known you for a while. I'm surprised for some reason those wires haven't become entangled and we haven't brought you on the show. But it's perfect.
I'm really elusive. So it's
yes, you are a hard man to track down with your many treks to the Himalayas throughout the years and things like that. But this actually is perfect timing because you have some great stuff that you just came out with that we want to talk about on the show that dovetails in perfectly to what we were talking about on our most recent episode. But before we even get started with that, what I like to do with all of our newcomers on the show here is give you a chance to give our listeners a little bit of an overview of your background in the options and derivative space, and then kind of what you guys do over at Condor Options.
Okay, good. Let me do this quickly. I do a couple things. I do a lot of research that I publish for clients, people who subscribe to our products, and that's kind of my primary focus. On top of that research, we do some trading-oriented newsletters, and I also manage client accounts as a registered commodity trading advisor. And then beyond that, I have some additional gigs. I write for The Streets options product. I write Expiring Monthly with Mark Sebastian and Bill Luby, and some other things beyond that. In terms of my background, I'm an autodidact, totally self-taught. I got interested in finance and in options when I was in college, and my academic background's in philosophy, actually. So it was always an intellectual, nerd exercise for me at the beginning. And as I kind of got more interested in options and some of the details of trading, it became a much more practical discipline. So my research focuses in, volatility, option strategies, historical research, and I take a pretty big chunk of time following the academic literature as well, because I think there's a lot of interesting strategies and ideas that come out of that research that sometimes, pure traders tend to overlook.
It's a shame that Jared has no credentials to be on this show, huh, Mark?
We don't allow psychologists on this show. I forgot to tell you ahead of time, so I'm sorry, but we'll have to cut this short. But your path to this space is an interesting one. Certainly unique from what most of our guests, and certainly a lot of us on the show here, former traders, former market makers. It brings a certain perspective to it. But coming from the philosophy path is certainly a unique one, and that gives you, I think, an interesting perspective on what's going on in the world of volatility. And speaking of what's going on in the world of volatility, let's just get right to it, because I can hear Don just panting over there, dying to get into this subject, and I know he's very excited, and I am as well. On the last show, listeners will remember we got into a discussion of black swan events, tail risk, pricing and downside puts, and whether or not this pricing is extremely overdone, and things like the black swan books and Nassim Taleb and how his books have fed into that hypothesis, and all the other swirling ethos around, and the swirling ether around, the whole black swan methodology and how it's impacted the markets over the past few years. And Don was not shy in expressing his, let's say, dim regard for that viewpoint. And ironically, no sooner did we finish recording that episode than I actually looked on my own site, which I tend to do from time to time, and I saw a great article up there from Jared. We pull some stuff. Jared's a contributor of ours. He pulls some stuff on Options Insider, and it was entitled "Why Taleb is Wrong About Markets and Uncertainty." So naturally, that caught my eye, given what we had just been talking about. And the more I dove into this, I realized this was perfect grist for the mill for us here on the show. I shot it over to Don. He loved it. And so we thought it's the perfect timing to get you on the show. But rather than have me do a disservice to it, Jared, and summarize it myself, why don't you give our listeners an overview of your main central thesis here in the article and some of your main findings?
Oh, sure. There's kind of 2 points that I make, I think, which are, first, that Taleb's wrong about the nature of, well, since this is an option show, we can use jargon, right? So I just think he's wrong about the cost of gamma in like equity index options and just in markets in general over time. Is the first point. The second kind of point of discussion in my article is about the more qualitative stuff that he wants to talk about with regards to uncertainty and policymaking and some of those bigger picture ideas. And that's maybe, I'm not sure how well that stuff is here, but it's kind of the defense after, if you get down in the gutter with the details and the data and you find conclusions you don't like, sometimes people will make appeals to this general notion of unquantifiable uncertainty or irreducible uncertainty. And to me, that usually ends up as a kind of a lazy intellectual move, because it's not a really argument for or against anything, which is something that I mentioned there. And so I just spend some time kind of debunking that rhetorical trick. But I think the real meat of the issue is Taleb right about the value of black swans and the magnitude of those events with regard to the daily ongoing costs of being long gamma, paying for options, paying for volatility. And to test that, I just took the history of equity index options and what the volatility, the implied vol has been, compared that to the historical volatility in the index over the same time frame, and found that there's a significant premium there. I mean, this isn't news to anybody. There's a huge literature on this, called the volatility risk premium. I wrote a little ebook about it a year or two ago, summarizing some of that research, and it's a really well documented fact of what goes on in option markets. And if you kind of take that premium, that ongoing premium implied over historical, and you look at that cumulatively, it's really large. It's extremely large, in fact. And what's most interesting to me is that the crises that someone like Taleb likes to point to as being so significant turn out to be very small in the cumulative history of that volatility risk premium.
Yeah, that to me was one of the really. There were a lot of interesting and really surprising findings in this article. One of them completely blew my mind, and I will get to that in a minute. I think you probably know where I'm going. But I think I encourage all of our listeners to go read this article for yourselves. I'm sure you can find it over at CondorOptions.com as well. If you want to look for it on Options Insider, a lot of you are already there. Just search for Taleb. That's the easy way to find it, and it'll come up right away. And TALEB. But I think the first part that caught my eye was the chart you put together comparing the 1 month historical and implied vol and how they lag with each other in several charts showing the lag of the realized actual vol versus the historical and how much they lag and how much you're paying a premium for this risk that's been priced into the market for ages. And a lot of people will say, well, yes, but the recent events, 08, 09, kind of proved Taleb right that if you had these puts in your back pocket, you were doing okay. But the problem with that is, of course, there's a cost of carry to doing that. You don't just have those puts; you have to put them on, and unless you have the best timing in the world, that's a cost of carry. And your analysis here really shows that the cost of carry of that is overwhelming. And even with these massive events, the meltdown, the European credit crisis, and whatnot, they as you even say in the article, they barely make a dent in how much you're actually spending to carry this insurance, this protection over time. And that, I think, is probably the first really interesting and kind of surprising takeaway, that those major events, which are Six Sigma plus events, though that was not enough to really make that strategy profitable in the long run.
That's right.
You know, Mark, we just dovetailing with Jared's work, one of the things that I mentioned, I think it was on last week's show, was way back when I was at Morgan Stanley, I obviously shared these views. I told you how excited I was to read Jared's article and how much I agreed with everything that he said. But we actually did a rather serious research piece that I titled "Looking Askew at Volatility." And so we looked at the volatility skew that was born of the 1987 crash, and probably did this in the early 1990s. I forget the actual date of publication. But, you know, we did a similar thing. We took a look at these out-of-the-money puts at the extremely high implied volatilities that they were trading at, and we just systematically hedged them over time as a seller, and found what a profitable enterprise this would be, you know, over a long-term basis. And of course, you know, you brought up the point that if you sell these things the night before the 1987 crash, well, unfortunately, your timing isn't very good, and you know, some people got carried out feet first on October the 19th of 87, but you know, that simply just doesn't justify, from a mathematical point of view, the concept that these high implied volatility options are there for a reason. And you know, the thing that's striking in all of Taleb's work is that you keep waiting for the punchline. It's like you read Fooled by Randomness, or you read Black Swan, and it's that feeling that you get sometimes where you keep on reading and you're saying, all right, well, where's the punchline here? You know, where's the guts of this? Are you going to come up with numbers at some point? You're talking about Greek philosophers and painting and art and this, that, and the other thing, but do you have some numbers to support any of this? And of course, the terrible disappointment in all of his books is that they are unbelievably devoid of any numbers whatsoever. And so, you know, you just come to the conclusion that there is no conclusion in terms of mathematics or justifying these things. And he just wants everybody to take it on faith that, you know, everybody who says that these things are not justifiable from a mathematical viewpoint, but rather only from a supply and demand viewpoint, he wants to go further, and he just wants us to trust him and believe him, but he simply doesn't offer up any evidence or documentation that would support such a claim.
Yeah, there was an interest. I got an interesting response from Taleb on Twitter when I
hold on for 1 second, Jared, 'cause I want to get into that, and that to me was what I was referring to when I said that completely blew my mind. But I want to set that up a little bit, because that is just too. That's changed my worldview. I can't believe that exchange. But before I even get to that, I want to point out one more thing on this, just for our listeners who are going to read along with this article. If they want to see another visual representation, I think look at Figure 2 in your article, because that gets exactly to what we were just talking about, what Don was saying about how, and Jared also, that here's the cumulative cost of carrying that vol risk premium, and you see a nice little blip around the 08-09 meltdown, and that's really about it. It still is just a massively downward sloping curve. So if you needed some extra convincing that the premium is just a wee bit overpriced, then that's definitely it. But your point, I've been dying to get to this now, Jerry. When I read your article, this is one of the reasons I really wanted to have you on. There are a few things I think I could have said with reasonable certainty, at least until reading your article the other day. You wake up in the morning, you're certain of things like the sun is going to rise in the east and set in the west. There will be taxes. There will be certain things in life. I also would have said one of the great certainties of life is that Taleb, Mr. Black Swan himself, is a premium buyer. That's just, to me, seemed like a no-brainer. Here's this guy who's made his entire name and worldview around the fact that there are these lurking unknown unknowns out there that you have to be prepared for. And yet you had an exchange with him on Twitter where he comes out and says Mr. Taleb, Mr. Black Swan himself, is a premium seller. He sells at the money straddles. Mm-hmm. That I can't wrap my head around that still. I don't understand how that jives with his worldview that he's been telling everyone on the planet. So not only does he not have math in his books to back up his beliefs, but his actual trading is actually more to the other side of that fence. I agree with your conclusion in the article that I would have assumed he would be long those straddles, and if he's short anything, maybe short way out of the wings to take advantage of his own overpricing. I have a
great explanation. Do as I say, not as I do.
Unbelievable. Unbelievable. But I'll let you describe the exchange, but I'm still reeling from that development. My worldview has completely changed.
Well, yeah, I think you characterized it well. I mentioned that, this is all occasioned, obviously, I guess we could say, by he has a new book out in which he argues that, and this conceptual distinction I don't think it's necessary, but it's not nothing wrong with it necessarily, but his distinction between something that's fragile, something that's robust, and something that's anti-fragile is just, I think you can characterize as, I would characterize it as being, fragility in his terms would be like being short options. I guess robustness would be like, cash, like a currency hedged basket of cash. I don't know. And fragile and being anti-fragile would be, being long options, long gamma, long vega. And so he has this new book out discussing that stuff. It's a 600-page long sort of discussion on various things, as you say, Don. It's a popular audience book, so there's not a lot of quantitative.
I was just going to say, any numbers in it other than the page numbers?
Let me say, in the interest of fairness, because he's not a dumb guy. He's had some success. He's done some interesting stuff. Even though I'm a critic, he does have this 300-page compendium of technical papers that he's written over the years, and it seems like his response to a critic like any of us would be, you should go look at this technical compendium of papers, and that'll answer all your questions, which is not a very charitable way to respond to a critic as far as I'm concerned. In academia, if someone writes an article that disagrees with you, generally it's seen that your responsibility is to respond on point rather than say, here, go read all of my books. You know what I mean? But he does have this compendium of technical work. Some of it some of it honestly has the feel of sort of trying to browbeat someone with formalisms. Here's more heavy duty math than 99% of you will ever be able to understand. So, a kind of a backdoor way of appealing to authority. Some of the math is tractable. Some of it, he makes common sense responses like, hey, you should take into account 1987 in your data comparisons. And that's something that I hadn't done in the charts posted on my site. So I went back, extended the time frame back a little bit to include, 1986 and 7 and all the data since then. The conclusion didn't change at all. It was the same phenomenon of a small blip higher in that cumulative vol risk premium, but otherwise no change. But so he's got some responses like that are cogent. But to the question of him selling options, I'm still kind of puzzled about this. The only thing I can figure is that ultimately what he's most interested in is being, long convexity, sort of long, extreme sort of stuff. So that if you, wanted to sell a bunch of at the money straddles and then buy some tails, then, if you finance that properly, maybe you could get away with very low or zero costs, most of the time. And then you still have your tail exposure. I mean, this would be similar to, I think in the Black Swan, the one sort of substantive strategy he mentions is what he calls a barbell strategy, where you would have most of your assets in cash equivalents or the risk-free rate, and then have like 10% of your assets in just like crazy out of the money bets, just like sort of crazy, long volatility, long complexity type bets, which is obviously we could agree that that's better than telling someone to go out and just buy tons and tons of puts all day. But it does, yeah. I mean, it is weird to me, the idea of why someone. I mean, it doesn't seem like an attractive strategy. I guess I could say that safely. Right. Sort of being a straddle seller and a buyer of the wings on an ongoing basis.
Especially in the time periods he lays out that are kind of his point for writing his books, that though that strategy doesn't tend to perform that well in those environments. I'm looking here at your Twitter exchange with him, and he just wrote back to you very, very, very quickly. He wrote back, he said, I always, and then in all caps, sell, SCLL, all the caps, so there can be no confusion, at the money straddles. That, like I said, up is down, black is white. I don't know what to make of my worldview now, because that inherently, he's inherently saying to you and to the world that yes, risk is essentially overpriced out there. So all these things I've been talking about and being 90% in a money market and 10% in nonsense, all of that is nonsense, because risk is already overpriced out in the marketplace. So all the things I've been beating my drum about with my warning bells and go hide in your bunker and do all these crazy things and don't invest in assets that are not safe, even though people thought they were safe. All of that is crazy. How do those two things make any sense together? I can't rationalize.
And I certainly don't have to explain this to Jared at Iron Condor or Condor Options, but the concept of, I've jokingly, Jared, on the show before said that butterflies are short straddles for cowards. and so basically, this concept of, I really do sell premium. I sell the at the monies, but then, of course, I can't have open-ended risk. So now I go out and buy the wings and pay up with these ridiculous prices, although that's kind of one-sided. You don't pay up for the calls, you pay up for the puts below the market. But be that as it may, the concept is, just what do you do? Tell us what you do. Do you buy in the same number? Do you buy enough so that it's a balanced, symmetrical butterfly, in which case when the Black Swan event takes place, well, you don't get anything out of that whatsoever, okay? You've got wings that are horizontal. You're not making any money. Do you not buy as much so that you don't get raped by the premium? Well, then you do have open-ended risk, because you've got some sort of a ratio on where you're short more options than you're long. So when the thing blows up, you still lose a great deal of money. Or do you actually buy more of these than what you sell, in which case you now have a kind of a W where the wings start to slope up and where you could make money with an untoward event. Again, more looking at the downside than the upside, but then you're paying even more in a ratio for this exaggerated premium. And I defy you to tell me that on any kind of a long-term basis with this put buying that you're doing in a multiple or a ratio to what you're selling, that you ever made money on that, long-term over the years.
Yeah, even if I sort of take the most sympathetic sort of risk profile I can imagine, it seems like something, and I guess there was some journalism on this, how, some investors kind of got impatient after just years and years of not seeing anything. And then, maybe the returns during kind of exciting years, volatile years, weren't large enough to justify. I'm not sure. But, I can imagine a really, really carefully done ratio where your carrying cost is relatively low and you do have some upside. Although, as you mentioned, like however that W shapes out, at least if you held at expiration, there'd still be areas where you could lose money in a big move, or you just wouldn't have that much exposure. And if you buy 1 year, if you kind of construct these ratios 1 or 2 years out, maybe you're not going to face the kind of loss in that W where you would at expiration, but you're also really giving up the potential for real movement. I mean, that's not being long gamma, long vega in a meaningful way when if your stuff is struck so far out that you're also avoiding that decay risk in the sort of middle, not the absolute tails, but the sort of 10% down maybe type
right.
risk. So yeah, I can't really imagine how that works or how that'd be something that'd be attractive to most investors over the long term. It
certainly is not anti-fragile, to say under any definition of that term. I don't think that could really be coined as that. It's interesting. I like both of you assumed he was just a hardcore degenerate premium buyer, if you will, and was hedging against all these risks. And maybe, perhaps, in a Machiavellian sense, I could have even given him some credit for perhaps buying the at-the-money straddles, even though I don't really agree with that strategy, and then writing the out-of-the-money puts, because perhaps in his grand scheme, he has contributed to those puts being so inflated, so he's taking advantage of that by writing those puts maybe on a ratio or something, and doing something like that behind the scenes to take advantage of all the furor that he has caused. I wouldn't agree with that, but I could at least respect that from a purely Machiavellian point of view. But the fact that he comes out here and does all these different strategies and analysis, or not even strategies, but discussions about the various risk levels. And at the end of the day, it turns out he's just like 90% of all the rest of the options traders who discover that short premium is a higher probability trading strategy, and he leans that way for the bulk of his strategies. I think if you have most people who read his book and then you asked him which way they thought he leaned from an options perspective, if they were cognizant of that, I would assume 99.9% of them would say long. And so
I agree with that, Mark. And so it really ultimately comes down to, so what is he all about? So what is this general thesis? If you're telling us that that's not the way you trade, but that maybe it wouldn't be interesting to write a book about that because now you're kind of in the mainstream, or at least you're in the mainstream of sophisticated sell side, investment bank type of upstairs operations, and people who've kind of figured out, as you've said, where the edge or the advantage lies here in owning the casino rather than being a player. Okay, then you kind of say, well, so what was this all about? What was this really all about? And maybe it's, well, the first way doesn't sell a bestseller, wonderful books. So why don't I come up with this theory where I say something that sounds a little bit revolutionary and that might catch the public's eye, and he certainly succeeded in doing that. But as Jared and I might be pointing out, and surely we're not alone, you just can't get away from the fact that there's really no rigor or mathematics to any of it. And his answer to that is probably, well, this is above the mathematics, And I give you a really quick digression. You guys know a little bit about my blackjack background, and I once had a friend who claimed to have discovered something where you could get a bigger advantage playing than the traditional methods of card counting and what have you. And I said to him, but you have no mathematical proof or whatever. You need to do simulations. He said, well, no, this can't be simulated. It just defies simulation. I said, well, how are you going to convince the public that it makes any sense? Well, he says, you just tell them that it's above the mathematics of the game. And you'll see. You'll get people who will buy it anyway. I said, I don't want to be any part of that whatsoever.
I love that, Don. But at the end of the day, math doesn't sell books, doesn't generate appearance fees and speaking fees, and certainly doesn't lead to people investing their assets with you and giving you that precious 2%. So yeah, those two goals seem to be in opposition to each other.
Yeah, it's like the old, you got to have a gimmick. You have to have a little hook somewhere that makes you different and differentiates your approach from everyone else. And if his goal was to be be a bestseller on the New York Times list. Well, he surely succeeded in that. But as far as options trading, I'm not so sure.
Yeah, I would want to add into this too that we can make a distinction between somebody who's just an outright charlatan and kind of just making persuasive, general audience arguments. I think that a charitable approach is fine. I don't think that Taleb's trying to manipulate anyone outright or anything like that. Not that you guys are suggesting he is, but we could avoid. I think we can avoid that interpretation just given the fact that he's someone who's worked with a lot of different people in academia, grad students and some other professors and stuff. There's a nice compendium of technical work, as I mentioned, that he has on his website. So there is some substantive detail there. My problem with it is that some of it is really high level formal work, but as far as I can tell, it's all kind of a priori, all theoretical. There's not really any engagement with the empirical data. And when he does engage with history or with empirical data, it's at a loose level, sort of talking about bank earnings. So he'll make an argument that, hey, look at all these banks in 2008 that lost more on their loan portfolios than they ever could have made. I'm not interested in that. I want to look at markets that are actually poised to make the kind of bets that he's talking about, which would be options markets. And that's why I focus so much on the implied volatility data that I was looking at, is that here's a market that's designed specifically to make the kinds of predictions and estimations that he's talking about. We should be able to look at that data, that empirical data, without a lot of sort of extra mathematical formalism added on top of that, and just look at what's happened so far in the data. We've got decades worth of history, and it's going to tell us something. We should listen to what that evidence says. So if I had looked at this data and I found instead that, well, maybe the volatility risk premium was a more recent sort of event, right? That's conceivable too, by the way, right? The term structure in volatility products keeps getting steeper. The volatility skew that you mentioned, Don, it kind of wasn't really around before the crash of 87. And so there's changing dynamics all the time. We could imagine a world in which that volatility risk premium didn't exist before a certain date, in which case, Taleb could be right empirically that maybe over a long enough time frame, it actually had paid off to be an option buyer. That's totally possible. And if that was true, then I would be the first person to line up and say, yes, empirically, historically, this guy has a point. We can quibble about what is the right strategy in today's market, but that's not what we find in the data, right? And that's the point that really sticks with me is whatever really technical formalism you want to work with in his technical work, or whatever sort of loose popular audience work, metaphors you want to do in his other books. At the end of the day, it comes down to your evidence, and when the evidence doesn't support a claim, then there's no reason to make it. And I guess that's the thing that bothers me most is his sort of philosophical attempt to say that whatever the historical evidence is, it doesn't really matter. And that's something that I just can't get around.
Yeah, I agree with you, Jared. I don't think any of us here are saying he's a deliberate fraud or charlatan or anything like that, but he certainly preaches one thing and seems to be doing another. And that seems to be, I have a little bit of an issue, I think, with that. I think because if he came out and said, I always buy out of the money puts, I mean, if you came away from his books with any sort of takeaway, I think you would assume that from an options perspective, he's at the very least buying out of the money puts. And he certainly could be doing that by selling them, financing them by selling straddles. But you think he would just be, in general, be net long premium and probably be a straddle buyer. And so this notion that he's instead a very, very apparently when he uses all caps for sell, that's what I expect from Don. I don't know if you know Don's catchphrase is sell or don't sell. So when Taleb comes out in all caps on Twitter to say he sells at the money straddles, he means it. And that to me just I have a hard time reconciling those two things.
What would it? Let me turn this back on you guys. What would it take for you to what would it take for you to I don't know, devote 10% of your portfolio to long straddles? What would have to happen?
We'd have to have 08, 09. I think would have to be a much more regular occurrence. If we had more of those, then yes, I would certainly be in the long gamma, long vol side of the fence.
You know what, Jared? I always kid around and say I was on the Morgan Stanley proprietary trading desk for 10 years, and I tried that once. It didn't appeal to me. It's just basically that overwhelming feeling, as Mark said, that I always joke that there are two things you ought to do with options: sell them or don't sell them. So I run into periods where not selling them may look like a more intelligent thing to do for a while, but to get to the next step of saying this looks like a great buy, is a lot more difficult for me. But, when I was reading his book and you talked about, Mark, you think, if anything, he'd be a buyer of straddles. I think I almost kind of thought, because that's really expensive, over the long run, that when I was reading it, what I really thought was that he just had some systematic program of owning out of the money options. And again, because the black swans are always, like a dire event, and therefore to the downside, the market doesn't crash up. So you're really not talking about two-sidedness here. Basically, I always just envisioned him as somebody that always had a healthy supply of these puts hanging around somewhere. And I thought to myself, what investment bank could you be at, as one of their traders, and just load up on these things year in and year out, waiting for something as revolutionary as a black swan to come around. And, when I talk and lecture about options, you say, the market crashed in 1929. And then, a mere 58 years later, in 1987, it crashed again, and granted a little bit more recently from 87 to 2008 and what have you. But these are just not things that warrant that you go out and say, I'm going to earn my living, being long out of the money premium. It just never made any sense to me.
Yeah, I agree. I assumed he just had baskets of out of the money puts all across the board. And you would think if he now, as we see, he is a at the money straddle seller, doesn't that in some ways also diminish because the value of what he's been saying with the out of the money put, because he's essentially admitting that strategy does not perform very well in and of itself, just buying out of the money puts. You have to do something else to make that viable. And once you start saying that pretty much puts the lie to everything he's been saying about this tail risk is underpriced in the marketplace, of anything. So yeah, I can't reconcile any of that. But I think it's just
it's what Jared just said. So you start to think to yourself, well, maybe he's looking for a way to finance this. He recognizes that this is too costly, and so then he's like somebody who does a collar, and you say, look, I own stock, so I have to buy out of the money puts so I can sleep well at night, but they're terribly expensive, so I have to find a way to finance them. So let me sell out of the money calls, and now it becomes a collar. You look for ways to do this, but the typical retail person or even a portfolio manager who puts on collars, he's on the wrong side of the skew both times. So he's paying up for the puts with the premium that is involved there, and then he's selling calls that are above the market, the wrong side of the skew. And the upstairs guys take the other sides of those trades and facilitate people who want to buy collars. They're the ones who are, taking in the right side of the skew and the premium. So as Jared was saying earlier, you try to look at this butterfly or whatever he's going to create, buying the wings and trying to finance it with the at the monies, and it just doesn't work. It just doesn't. You can't find something, no matter how you do it, diagonally, different time frames, whatever, different ratios. It just simply doesn't add up, or I'm missing something.
I would just summarize it with this, because I don't want to keep Jared here all day to have him bash on Port Talib, but it is, I think Don and I could certainly go on this for quite a while. And Jared, I don't want to give you the impression that I do nothing but sell options. I do a little bit of both. I'm not as inveterate on the selling side as Don is. But, I would just say this. If he obviously has this view of that, that at the money risk is overpriced, or he needs to finance his out of the money puts, and he has obviously some hedging to what he's been saying all this time about these things, then say that somewhere. Say, hey, I say this, we should be long these puts. That's an expensive strategy. Here's some ways that could be offset. I mean, obviously that's very specific. He doesn't directly address option markets in his book, but somewhere along the line, or maybe in a footnote, perhaps I missed a footnote, maybe that's in there, but that should be a section of the book where because the whole treatise of the book is that risk is, this risk is out there and it's not fully realized. So you should be prepared for it. This strategy is not that. So I would say then, that should be somehow in there that, this is a difficult thing to do over time. You need to take these steps to if you want to actually have some outside risk. And even then, this strategy doesn't really work that well in that environment. So maybe don't do it.
Yeah, let me recommend to people too that his first book, Dynamic Hedging, which is an options. It's a finance book. It's not really for a general audience at all. It's pretty good, and there's better books about quantitative finance, but that's the first book I encountered of his, and that's why I actually was, when I first read The Black Swan, I was thinking back to the Dynamic Hedging book, and I thought, this is the guy who knows this stuff, so this is an interesting thesis, and I was kind of excited about it. I think, like a lot of people, I think. Going back to the Dynamic Hedging book, it's, I think it holds up pretty well. It's interesting to read, and some of the other technical papers are worth a look as well. But let me leave people with this, beyond just the falseness, as far as I can tell empirically, of the long gamma thesis. I think there's some other things that you could say, which are that in the kind of market that we're in right now, the sort of economy and world situation is such that people who only trade U.S. equity indexes are really missing out a lot. There's a lot of stuff going on, whether it's in other markets or commodities or currencies, where you can trade volatility just as well, and the return distribution is different enough that there's some meaningfully different strategies you can do. It's not all the same thing, on all the same markets, and I think that's worth exploring. That's something that I've been doing a lot of research over the last few weeks about the Japanese yen, and I think that's going to be a big story this year. And so that's just one example. There's really interesting stuff going on there in terms of the vol skew and what the options markets are doing. So I think it's worth people kind of expanding their scope beyond just U.S. equities. The other thing I would mention to leave with people too is that I would actually make the argument that this volatility risk premium has become larger in recent years more than anything. Even, partly because of the crisis. If this thesis of Taleb's was ever true, its best chances are behind it, I think, because when you look now at something like the term structure of whether it's S&P options or certainly in VIX options, or just the premium in VIX options over what happens in realized vol terms in the futures, I think there's really massive premiums there that even outstrip what we're used to seeing from just like a VIX versus historical vol comparison, like I was charting on the site. I think that the premiums there are even larger. They seem to be getting bigger in some cases over time. So if anything, I'd be like even inclined to be even more aggressive now. And I guess somebody like Taleb and people who want to buy protection on a constant basis, I guess you need all sides to make a market, I suppose. To me, the opportunities on the short side are more interesting than ever, though.
I guess that apparently, at least maybe not in the tail risk, but at least in the at the money, is how Taleb feels as well. Jared, I want to thank you for coming on today. I think this is a really interesting analysis you've done here. I would encourage all of our listeners to visit condoroptions.com to learn more about this and everything else you have going on over there. And before you go, why don't you give our listeners a little bit of a tease for anything interesting or exciting you have coming up over in the land of Condor options?
We try to be as boring as possible so that people can learn what we're doing and kind of feel like they're on board. I have made a big effort over the last 6 months to kind of expand the research and analysis side of the newsletters that we publish. So, we've got metrics up there. If you like the kind of stuff that goes on this podcast, I think that our newsletter would be a good fit, really. We look at the S&P implied vol skew on a weekly basis, charting it versus the last several years worth of historical data. We look at volatility risk premium, which we've been talking about. We look at what's going on in the VIX futures in a kind of a systematic data-driven way. And I don't know that many sources other than like big banks who look in this stuff in this level of detail and kind of trading against it. So people can check us out. I think that there's a free trial or a cheap trial for someone who's never looked at our stuff before. In terms of the trades that we publish, the returns are good. I don't like to get into details because it's kind of gauche, but the returns are good, and we don't take a lot of risk. And so I think there's something interesting there, whether you're a newer trader who kind of gets the idea of an iron condor and wants to learn how it works, or if you're like a moderate to experienced trader and you want some more analysis of some of the more interesting corners of the options market, that's something that I've really been focusing on recently. And in terms of upcoming events, I'm giving a talk in February at the Traders Expo in New York, and we may do a webinar in the near future in the next month or two as well. So that'll be up at condoroptions.com for anyone who wants to track me down.
There you go. Check out condoroptions.com, listeners. Of course, you can also find some of Jared's stuff on the Options Insider. He's one of our great contributors over there. And the name says Condor Options, but there's a lot more lurking underneath the surface there over there. So you come in for the Iron Condors, but then you get interested in all these other things you have going on over there as well. So it's kind of like a stealth approach. I like what you have going on, Jared. Well, thanks again for coming on. I think this was a fantastic discussion, and we'll certainly have to bring you on again down the road to discuss more of these interesting developments, perhaps in the yen and some of the other things that you're seeing out there in the other various volatility products and ecosystems floating around out there.
Awesome. Thanks.
All right, and that's going to do it for the Volatility Viewpoint segment. And now we're going to dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball. This is, of course, where we discuss what's on our mind for the future of volatility. I don't know about you, Dom, but I'm still reeling from that conversation from the Volatility Viewpoint segment.
It certainly was fun.
You know, we always talk here about realized versus implied, and how if you're truly cognizant of that volatility risk premium, you'd be selling options in a lot of these environments. And perhaps not as aggressively right now, but still doing it. But it certainly seems like even in this environment, Talib will be hitting the bid. That's just crazy to me. Crazy. But that aside, what we talked at the top of the show about how even though we have some relatively appreciable levels in realized vol right now, the actual movements to correspond to those haven't been particularly impressive, partially because we're in such thin markets and there's not really a heck of a lot going on. So people are waiting for the big developments to come out of Washington. So we're managing to sustain our realized vol levels, but not really add or subtract to them in any meaningful way. So that said, I know we said at the top of the show, you're perhaps selling with one hand, definitely not selling with two hands. Perhaps selling with one hand or just keeping both hands behind your back right now, Don?
I have to tell you what I find interesting about today is as we are recording now, it's about 1:30 Central Time on Friday. The markets are virtually unchanged. The Dow is down a little bit. The S&P is down fractionally. But then when you take a look at VIX, and given that the weekend is coming up, you see something that ordinarily I would say is quite unusual and extraordinary, but it has been happening with a great deal more regularity recently, and both you and Mark Sebastian have pointed it out. And that is that VIX is actually up almost a full point, and percentage-wise up about 5 3/4% on the day. And, despite that normal discounting for the weekend, and all you can possibly attribute it to is the tremendous uncertainty of the fiscal cliff and what's going on in Washington at the moment. And actually, instead of, the decay of the weekend, we have to change it and say the fear of the weekend, that something could develop in an hour or two, or even if they're working feverishly on Saturdays and Sundays these days in Congress. And so I really think that to cut right to the chase, any kind of forecast of volatility from here to year end, whatever side you want to take, we're low, it's going higher, things are going to get resolved and it's going lower. I think everything in terms of predicting whether it's implied or realized volatility for any of the indices is simply what your viewpoint is on what kind of resolution we're going to get on the financial situation. We talked about it till we're blue in the face about the inverse correlation between movement in volatility and movement of equity prices. So if you think that the fiscal cliff is not going to get resolved and it's going to blow up the markets and we're going to go much lower, then your obvious conclusion has to be that volatility will be going higher in the weeks to come. If you think there's a resolution, a compromise, and every time word comes that there might be, the market starts to immediately, trend to the upside, then you have to say that volatility will be lower from here to year end. This is not the time to be looking at volatility cones or Garch forecasts or anything else. All of that stuff is trumped by this inverse correlation, and you tell me what's going to happen there, which means you'll tell me which way the market is going to move, and I will take the opposite side for where volatility is going. I think it's as simple as that.
Yes, we're in that environment where the fundamentals are out the window, technicals are out the window. There really is no analysis you could do unless you're in the meeting halls over there in Congress that could somehow further your analysis of the situation. It very much is one of those throw the dice type of scenarios, and you have to prepare for that in both ways. And you're right about the weekend fear, the weekend risk. And I've been hitting on this for some time on this show and others, that we've seen a number of events over the past year that have really hit home the very quite literal, in some cases, weekend risk. Look back just a month ago to Hurricane Sandy. That all unfolded over the weekend. So if you haven't learned over this past year that perhaps it's not always the wisest course of action to blast out and hit bids at 3 p.m. on Friday afternoon, or even in the early afternoon or morning on Friday, trying to chase that weekend decay. And sometimes maybe leave a little bit in your back pocket, or just don't sell, as Don might say, right, for those events. That these past few months have certainly been reminders of that. And certainly in this environment where anything could happen at any time, you certainly don't want to be chasing that decay going into the weekends. Be thoughtful at least about the risk reward that you're selling. If you're selling at 3 p.m. on Friday, you probably missed it. You're selling on Monday or maybe Tuesday's levels at that point. So don't give away a weekend for nothing.
I agree with that.
So yes, by all means, keep your powder dry perhaps for the coming weeks until at least we see a little bit more about what's going on. Unless you're Talib, then by all means hit the bid on all those ATM SPX straddles, because that's what he does. So like I said, I'm still digesting that, listeners. But I think in terms of this show, we've gone a little long, so that is going to do it for this episode of Vol Views. A good one, I'd say, Don. Certainly a lot of grist for the mill, a lot of food for thought for our listeners to chew on over this coming week. But before we go, I want to check in with you guys over at volex.us. I know you have a lot of interesting things percolating out there on the horizon. Is there anything you could share with us about any of those events at this time, or is it all still shrouded and cloaked in mystery?
No, we're getting definitely closer. We actually have a proposal, a term sheet for an exciting partnership, and we have it in the attorney's hands, and so we're inching closer through all of the legal red tape to what I think will be an exciting announcement that we can share with listeners very shortly.
Well, I'm looking forward to that. I know our listeners are as well. And even though he couldn't make it on the show today, I'll throw him a plug as well. By all means, surf on over to optionpit.com to check out what Mark and Andrew and those guys have going on. And you can also check out his seminar. That's going to be all about a whole day of volatility with Mark Sebastian and the guys from the street and the guys from the CBOE over at the CBOE. I believe it is coming up very shortly. I don't have the exact date on me, but you can, of course, go over to optionpit.com/events and find out more for yourself. And, of course, we didn't have a chance to get to your questions this week in the mailbag. I apologize for that, listeners, but that interview kind of went long as Don and I got to express some of our views on the Black Swan. Let's just say the Black Swan furor that's engulfed the markets over the past few years. And so, I definitely encourage you to keep sending in those questions and comments. We'll get to them on an upcoming show. You can reach us, questions@theoptionsinsider.com. Just put question for Vol Views in the subject line so we know what show you're referring to. You can also reach out to us posting a comment on the website at theoptionsinsider.com, or using that feedback form to send us an email feedback. That works as well. Or you can hit us up on Twitter. We're just at Options on Twitter, or search for Options Insider on Facebook. Those are all great ways to get in touch with us and get your voice heard and read aloud here on the old program. And on behalf of Don and Mark and, of course, myself, I want to thank all of you out there for downloading and streaming and subscribing to this show and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.